In this second part of modern portfolio concepts, we'll talk a little bit more about the relationship between risk and return and how diversification ultimately works. So first of all, let's think about diversification, eliminating risk. One of the challenges we have is that we can't eliminate all of the risk. There is a part of risk. It's non-diversifiable or undiversifiable, that you can't get rid of it. And this is the risk that worries investors the most, right? The risk that you can eliminate is no problem to you because you can get rid of it. But this risk is the risk that you're stuck with. So if we think about risk, it has two parts. Part of it is diversifiable and part of it is undiversifiable. So this diversifiable risk is sometimes referred to as unsystematic risk or company-specific risk. Right? This is the risk that comes from the company itself, from the industry that the company is involved with. So this risk is not related to any other company. So the events that happen to it will not influence other events. So when we put it together, right, with other assets, the outliers, right, those outlying events will ultimately average themselves away and create less risk. The undiversifiable piece is that piece that you cannot get rid of it, even if it's a well-diversified portfolio. And that's because the things that affect this systematic risk, sometimes referred to as market risk, the things that affect this are the things that affect everything. Growth in the economy, inflation, interest rates, right? It affects everything. So there's no way to offset it since it is affecting everything. So the total risk of an asset is the sum of undiversifiable and diversifiable risk. We measure total risk with standard deviation. So here's our formula. Total risk is diversifiable risk plus undiversifiable risk, or market risk plus company-specific risk. Remembering that this risk, company-specific risk, is the stuff that disappears when we create portfolios. So this example shows what happens as you build a portfolio. If you had a one-stock portfolio, the average risk is at this level up here. And this comes from a study that looked at the New York Stock Exchange. And basically, the average risk of the average stock in the New York Stock Exchange was around 47%. But what they found is as they created randomly chosen two asset portfolios, so they randomly picked two stocks, put them together in equally weighted portfolios, and calculated their standard deviation. And they did that randomly over and over and over again. And what we found is as they created larger and larger portfolios, the risk decreased. And it would continue to decline till it got to a point where adding more stocks, adding more investments, did not dramatically reduce the risk anymore. So what we have is the total risk is this dark green line, and the piece that's dwindling away here, that's diminishing, is diversifiable risk. The piece that you cannot get rid of is the undiversifiable risk. Now what happens when we add international securities? The red line is domestic only, but we ultimately then have a portfolio of domestic and international assets that's it will go down quicker, it will have less risk, but eventually it's going to get to a point where adding more stocks will not dramatically reduce the risk. So there is a part of risk, no matter how you create the portfolio, that no matter how hard you try, you won't be able to eliminate all of the risk. And this is a part of a statistic that's referred to as beta. Beta is a number that quantifies this undiversifiable risk, or the market risk. It indicates how a security's return responds to fluctuations in the stock market. So we can do this graphically, we can do it algebraically, right? But eventually, again, if you've had a statistics course, you know that there's something called a line of least squares. And these least squares, errors, types of lines try to describe assets or describe a set of points in the way that creates the least amount of error in estimation. So we end up with a formula of a line. And let's just show you the actual outcome. Here we have two stocks, right? Here's Y. This green stock is UPS, and the characteristic line here, the blue one, is FedEx. And what you see is the lines kind of intersect each other at one point, but what we have is UPS has a lower slope, a smaller slope than FedEx. The slope here is what we refer to as beta. Whatever that number is that measures this change, that is how we measure beta. So how do we interpret beta? The beta for the stock market is 1.0. So the beta for the S&P 500 measured against the S&P 500 is 1.0. Stocks can have positive or negative betas, although nearly all investments all stock investments, especially domestic investments, are all going to have positive betas. The positive sign in front of the beta merely talks about which way the stock will move when the stock market moves. So most stocks that we can look at, especially domestically, will have a beta between 0.5 and 1.75. So how do we interpret this? A beta of 0 means that this asset is unaffected by the stock market. If the stock market moves, this thing probably will not move at all. But if we have a beta of 2, that means that it moves in the same direction as the market and it's twice as responsive. So if the stock market goes up by 10%, the asset with a beta of 2 would go up 20%. And likewise, the opposite would happen if the beta was negative 2. If the stock market went up by 10, this asset would go down by 20. And we can look at this mathematically. Again, this portfolio beta and return worksheet. There's a spot where you can input beta. So we have a stock of beta of 1.5. If the stock market changes by 15%, we would expect to see a change of 22.5% in this stock's return. It has a higher beta, which means when the market moves, it moves in the same direction, but in a greater magnitude. And likewise, if the beta was less than 1, it moves in a smaller magnitude when the stock market moves. And there's lots of stocks that we can find. Betas are, quite frankly, very easy to find. You can find them on Yahoo Finance. So this is from February 27th of 2015. These are the betas for these companies. As you can see, we have some stocks with pretty high betas. Molson's is 1.45. The Gap is 1.63. Celgene, we talked a little bit earlier, is 1.84. But we also have some very low betas. Walmart is 0.29. Sempra Energy, 0.39. So these numbers, again, represent the market risk of the stocks. And again, kind of think back to our risk-return relationship that we've talked about a couple of times. As risk goes up, expected returns go up. We can actually put this in a formula form, and this is a formula that comes from the capital asset pricing model, and it has 3 basic components. It has a risk-free return, the beta of the asset, and R sub M is the average rate of return of the stock market. And this formula then says the required return on the stock is the risk-free rate plus beta times the risk premium in the stock market. So if the stock market were 11 and the risk-free rate were 3, this difference, the premium, is 8%. So it's 3% plus beta times 8%. So if beta were 2, 2 times 8 is 16, plus 3, you would expect to get around a 19% rate of return on the stock. If we graph this line, what we find is here's the risk-free rate is 2%, and the security market line is a straight line that goes up from there. At a beta of 1, we would say that the stock market earns an average of about 8%, and the risk premium is 6. But if the beta were 2, we would then say, well, what's going to happen to the risk premium? If the beta doubles, we would find that the risk premium would double. So again, the risk and return relationship holds, and the capital asset pricing model, with the help of the security market line, helps us to describe that relationship. So again, let's kind of step back and think about this a little bit, right? You're thinking about buying a Bank of America stock, and the beta is 1.33. When you are making this decision, the risk-free rate is 2, and the expected market return is 8%. So if you plug these into the security market line formula, you would expect to get 10% if you invested in Bank of America. If the beta were 1, you would only expect to get 8%. If the beta were 2, you would expect to get 14%. So again, the point is, the higher the beta, the greater the rate of return that you expect when you're investing in assets. So again, completing this example, right? Risk-free rates 2, market returns 8. If the beta is 1.33, the expected return on this stock would be 9.98%. So what can change the expected rate of return on the asset? Well, if the risk-free rate changes, if something happens that the rates of returns on treasury securities increases, then the return on the stock will increase. If the risk-free rate goes up, all rates go up. What if the stock market declined? What if the stock market averaged only 7%? Then the number would be less, so we would get a lower rate of return. So again, there's many things that we can think about how that would ultimately affect the expected return on these securities. So again, this model basically links risk and return. It helps us define the return that you expect on a particular investment given its risk level. As beta increases, the required rate of return increases. Again, market risk, as measured by beta, is the only important risk when you're thinking about making or creating portfolios. So this capital asset pricing model has some limitations. Generally, it relies heavily on historical data, so the value of beta is typically historical in nature. It's a picture of what has happened in the most recent past. Since it's estimated from historical data, it may or not accurately then reflect the future. So the idea, though, is it has challenges, right? There are some issues with the capital asset pricing model. However, it is a very simple model, right? It exactly links risk and return, and that's an important tool for investors. It's widely used in corporate finance, and many surveys show that it's the primary method that companies use to determine the required rates return on their stocks. So that's the end of Volume 2 or Part 2 of the Modern Portfolio Concept section.